Welcome back to Investing Tutorial. Today, we're diving into a critical aspect that significantly influences investment strategies and financial decisions: the inflation rate in the U.S. economy. Understanding the dynamics of inflation is pivotal for investors, as it directly impacts purchasing power, interest rates, and overall market trends. In this episode, we'll unravel the nuances of the inflation rate, explore its implications on different asset classes, and equip you with strategies to navigate your investments in an inflationary environment. Whether you're a seasoned investor or just starting, this session will provide valuable insights to help you make informed decisions in the ever-changing landscape of the U.S. economy. Stay tuned for a comprehensive guide to mastering the intricacies of inflation and its profound effects on your investment portfolio. The fight against inflation led by the Federal Reserve Bank just got a little bit more difficult. As you may recall, the Federal Reserve Bank has been trying to reduce inflation by raising interest rates. However, recent data indicates that this fight isn't going as the bank had planned. As a result, the bank now faces the difficult decision of whether to start cutting interest rates even earlier than anticipated, even though many Americans, including the White House, are hoping that it will happen sooner rather than later. That being said, the Federal Reserve Bank considers three primary criteria when determining the appropriate interest rate: consumer inflation, producer inflation, and the state of the economy. Since consumer inflation is the kind of inflation that you and I experience on a regular basis, allow me to begin by discussing it. Consumer inflation is a problem that consumers have when they have to go out and purchase items like groceries, a home, a rental property, or a vacation. Producer inflation is the inflation experienced by business owners when they have to go out and purchase goods, services, or raw materials in order to make something that they can sell to customers. The third factor that the Federal Reserve Bank considers is the rate of economic expansion and the state of the labor market. Over the past 10 days, all three of these factors have shown significantly higher than anticipated temperatures. Let me begin by discussing consumer inflation, or CPI. According to the most recent statistics we have as of Valentine's Day, 2024, consumer inflation is increasing more quickly than anticipated. Let me tell you the details straight from CNBC. Core inflation was 3.9%. It is more than the 3.7% inflation that was anticipated and obviously larger than the 2% inflation target set by the Federal Reserve Bank. Remember, the Federal Reserve Bank prefers 2% inflation over 0% inflation, and its preferred inflation measure is core inflation, which came in at 3.9%, nearly twice the target inflation rate, and the 3.9% inflation that we actually saw was higher than the 3.7% expected inflation, indicating that the consumer inflation was hotter than expected. A little while later, we received the producer inflation numbers, which also showed hotter than expected producer inflation. Let me read you another quote straight from CNBC. If you want to read up on this yourself, I'll include links to the articles in the description. It stated that the Producer Price Index, PPI, excluding food, energy, and trade, increased by 0.6%, marking the largest monthly advance since January 2023. This means that the producer price inflation was also higher than anticipated, making it one of the hottest months of inflation in roughly a year. Finally, we have the economic data, which is what the Federal Reserve Bank uses to set interest rates, that they possess in order to maintain economic and inflation equilibrium. We recently learned that consumer inflation is more than anticipated. Businesses are experiencing higher than expected inflation, but they must weigh this against the overall economy. Generally speaking, higher interest rates are meant to slow down the economy because businesses will naturally borrow less money when borrowing costs are higher. The Federal Reserve Bank uses this strategy, but so far, the higher interest rates haven't really had that effect. Because shortly after this data, we received the most recent economic data regarding the state of the American labor market. It stated that, contrary to expectations, the U.S. economy added 353,000 jobs in January, meaning that employment is now growing faster than anticipated. Although this may seem like good news, the Federal Reserve Bank was not pleased with this development. Let me now discuss why the Federal Reserve Bank views this as bad news when work summers turn out to be hotter than anticipated, and all of this is essentially related to the inflation indicator that the Federal Reserve Bank monitors. Since if everyone is employed, that implies that everyone is earning money, which implies that everyone has the capacity to spend money, which implies that everyone has the capacity to incur debt and spend even more money, which implies a robust economy and increased demand for goods, which is fantastic news in a normal economy. You want people to go out and get employment. You want people to go out and receive salary increases. And you want people to go out and get credit so they can go out and spend money in the economy. I'm not advocating that you take on debt in order to help the U.S. economy. However, I contend that this is how the economic system operates. And in an environment where inflation is already a concern, the fact that an increasing number of people are gaining employment and having the means to support themselves is bad news for the Federal Reserve Bank. This is why they consistently declare their desire to loosen labor laws, which is a politically correct way of saying that they want higher unemployment and job losses. However, they are reluctant to make such a public declaration because it will undoubtedly spark controversy. Yet they have come out and indirectly stated that they want to soften the labor market and that they expect unemployment to rise as a result of higher interest rates. As a result, we are currently in an economy where the Federal Reserve Bank has been working to raise interest rates in an effort to reduce inflation, which has the unintended consequence of increasing unemployment. The problem is that inflation isn't decreasing as quickly as the Federal Reserve Bank would like, which leads to both higher unemployment and a cooling economy. Although that hasn't actually occurred yet in the U.S., many people are currently anticipating and hoping for it. That the economy will eventually cool off, perhaps in the second half of 2024, but we haven't seen it yet. This is because, as traditional media outlets like to say, Americans are resilient. People are spending money carelessly and on credit cards, which has recently reached all-time highs. People are also using buy now, pay later credit cards. It has become very common for Americans to be in debt and to see it as normal. However, this is the problem. A problem on the side of the consumer. As a result, there will eventually be a breaking point for everyone. And when that happens, people will have to cut back on their spending. This means that all of the businesses that have been reliant on all of this debt spending will not be able to generate that revenue in the future. And if they can't generate that revenue, sales will slow. This is a natural byproduct of our economic system. Since everyone will be broke and in debt, there will be problems for the economy. Our economic system, after all, goes through cycles. This has been the case for decades over the past century, but the reason this is more significant now is the amount of debt that exists in our system. Not only do households, corporations, and the U.S. government have the highest cumulative debt of any one entity, but the concern is that as more and more Americans take on debt in order to finance their lifestyle, it will negatively impact their ability to continue spending when times get tough. After all, tough times come with the territory. This means that when times are bad and they have to pull back, you can see why that could lead to further economic suffering in the future. It also presents opportunities for those who are financially literate and aware of what's going on, but it will hurt everyone else. This is where you start to see a wider gap between those who understand money and those who don't. An increasing number of people lack financial literacy and wonder why they are. Being left out of the system. Finally, we just look at interest rates. Treasury yields are another factor you should be aware of. Treasury yields, on the other hand, are the interest rates you may obtain by lending money to the U.S. government. This rate is referred to as the risk-free rate because anyone can lend money to the U.S. government. It's possible for you to do it too. Governments can do it. Anyone can do this, including banks, if they lend money to the United States. This is because lending money to the country almost guarantees a return because the government can tax its citizens to pay off debts and can even impose taxes on those who cannot afford to pay it. The second thing they can do is print this money. This means that barring the United States government from defaulting, which is of course possible but not very likely given that they have the strongest economy, military, and central bank in the world, making it extremely unlikely. For this reason, many people like to refer to the rates at which Treasury bonds are issued as risk-free rates. However, we have seen a steady increase in these yields, particularly in the last month. Slowly over the last month, you can simply Google the 10-year Treasury yield to get an idea of what I mean. The reason this matters is that even though the Federal Reserve doesn't affect interest rates, a bank lending you money is an investment, and when a bank lends you money, it is making an investment in this loan. As a result, the bank must weigh its options carefully, considering the risk versus the return of keeping the money in the bank account. Then they say, well, what if we take a little bit of a riskier investment and we lend this money to the United States and government? Low risk and a higher growing return. Then they say, well, what if we lent this money to you to buy a car or a house? More risky because you don't have a money printer like the government and you can't generate taxes like the government? You are a bigger risk than the United States government is. Therefore, if I'm a lender and I'm going to lend you money instead of government money, naturally, I'm going to expect a higher rate of return from you. This is the reason you need to be aware of these Treasury yields. Despite the fact that the Federal Reserve Bank hasn't raised interest rates in almost a year, consumers' interest rates to purchase a home, a car, or to pay off credit card debt have been rising as Treasury yields have been rising over the past month. This is important for you to understand because there are many different factors that affect different aspects of the economy, which is a vast and intricate web of interconnected systems. So instead of becoming a panicking investor, you can become a more financially educated investor. This is because wise financial decisions are never made out of fear or panic. Therefore, you should be sufficiently educated to comprehend the various factors influencing our economic system in order to identify opportunities and accumulate wealth for yourself regardless of external events. As we conclude this deep dive into the inflation rate in the U.S. economy, it's clear that staying ahead of economic indicators is paramount for any savvy investor. Inflation, with its multifaceted impact on investments, demands a strategic approach. By understanding the factors influencing inflation, its potential consequences, and adopting proactive investment strategies, you position yourself to thrive in a dynamic financial landscape. Remember, knowledge is the key to informed decision-making. Keep a keen eye on economic trends, stay diversified, and continually reassess your investment strategy to ensure resilience against the ever-changing currents of the U.S. economy. Thank you for joining us on this journey, and until next time, happy investing.